In this video, we're going to look at LyondellBasell, and they're a large chemical company located in the Netherlands, and they also have headquarters in Houston, Texas. So what I do in my videos is I run a discounted cash flow model, and that way I can figure out the stock price of the company, and I use prior financial information to figure that out. So I'm going to walk you through the model. First, we need the market cap, which is 21.14 billion. Next, we need the stock price, which is 63.37. And now we can figure out the shares outstanding, because it's the market cap, 21 billion, divided by the stock price, $63, equals 334 million shares outstanding. We need the shares outstanding because when we figure out the value of the entire company, we have to divide it by the number of shares to get the stock price. And the way we value a company is we estimate the future free cash flows of that company and discount them back to today's dollars. And right now I'm looking for the free cash flows, the actual free cash flows for the past 4 years. And I'm going to put that into the model. And next I'm going to get the net income, and that's a profit and loss for the company. And that's on the income statement. And then I'm going to pull the revenue, which is also on the income statement, and this is the sales for the company. So you always want to look at the numbers to make sure you input them correctly, but also to make sure they look appropriate for a DCF model. And the way it's appropriate is if they're consistent and positive, and these numbers are both consistent and positive. The free cash flow ranges from 2.3 billion to 3.7 billion, which is pretty healthy for a company to have that much free cash flow. Free cash flow is how much money the company has after operating its business minus capital expenditures. Capital expenditures are purchases of large machinery, buildings, things like that. They also have nice net income and healthy revenue. Now we need to look at the capital structure of the company because we need to know what to discount the future cash flows by. The interest expense is the interest they pay on their debt, and that's $350 million. And that's on the income statement. Now let's look at the balance sheet because we want to find out how much debt they have. So we'll go to the liabilities section, and then the current liabilities shows the current debt. That's debt due within 1 year, that's 450 million. And then the non-current liability shows the long-term debt. That's debt due beyond 1 year, and that's 11.5 billion. So they pay a little under 3% interest on the debt. But interest payments are tax deductible. So let's get their effective tax rate. We'll go back to the income statement, and we're going to look for their income before tax, which is 4 billion. And then their income tax, which is 650 million. And now we deduct the taxes from the interest rate. So the cost of debt comes down to 2.42%. That's how much it costs this company to obtain debt financing. Next, we need the beta, which is the volatility of the stock. And we could go back to Yahoo Finance, and in their main page we could find the beta of the company, and it's 1.58. So that means the stock moves about 1.5 times what the market moves. So if the market went up 1% tomorrow, the stock should go up 1.5%. Let's pull their current assets. That's on the balance sheet, and these are assets that can be liquidated into cash within 12 months. And that's $9.5 billion. And their current liabilities are liabilities and debts that are due within 12 months, and that's 5.2 billion. We're going to pull their equity, which is the total value of the company according to the balance sheet. That's total assets minus total liabilities, and that's 8 billion. Now we need their EBIT, which is earnings before interest and taxes, also called operating income. And that's 4.1 billion. So now we know the weighted average cost of capital because it's a blend of the cost of debt, which is 2.4%, and the cost of equity, which is 14.5%. The WACC, weighted average cost of capital, is 7.2%, and that's a discount rate we're going to apply to the future cash flows. So we estimated the future free cash flows for 4 years. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today. And we come up with a value of the company of $38 billion. We divide that by 334 million shares, and we come up with an intrinsic stock price of 113. It's trading at 63, so it's a buy according to the model. It's trading at a 44% discount. Let's see what Simply Wall Street values the company at. They're at 98. They also do a valuation. So my number is more conservative with this company. But we're both in the same range by valuing a company beyond what they're trading at. And you could see the company was trading at 110 or so a couple years ago, but it's dropped a lot and it's come below intrinsic value. So the stock price is not based on the financial information of the company. It's based on the supply and demand of the market. So apparently the price has been pushed down because people kept selling the stock until it came down to $63. The 52-week range for the stock was between $34 and $99. Let's look at the financial ratios of the company to get more information. Grade PE 6.2. I like to see under 15. That's price of stock over earnings per share. The average in the entire market is 28 and the median in the market is 16, so they're much better than the average. Really low price of sales, 0.6. That means investors are willing to pay 60 cents for $1 of sales. And the average in the market is 4 and the median in the market is 1.8. And that's price of stock over sales per share. They also have a pretty good price to book, 2.6, which is lower than the average of 3.9. And the median is 2.3. They have a pretty good current ratio, 1.8. That's current assets over current liabilities, so they can cover their current liabilities almost 2 times. Great ROE, 42%. That's net income over equity. And equity is total assets minus total liabilities. So they're providing their equity holders a really good value. Interest coverage ratio of 12. So they could cover their interest payment almost 12 times. 60% debt. It's a little on the higher side, but they're able to cover their expenses and they have healthy free cash flow. So it looks pretty good for a company. I don't have any similar companies to compare them to. Possibly in the future, I'll do more videos with companies in this industry, but as of now, I don't have any. But if you want to learn anything more about this company, just shoot me a comment and I'll be happy to answer it. Thanks for watching the video.